This is 30minutetrading.com. First thing to talk about is the disclaimer, money and risk management, real-time trading apps, and Q&A. We've had a webinar on all of this, so this is a summary of some aspects of that webinar. First off, disclaimer. Please pause the video and read the disclaimer and make sure you understand it before you carry on. If you're happy with that, you accept this by reading that and you carry on. Also look at the CFTC Rule 4.41. Please again, pause the video, read this, make sure you understand it, and then you can carry on. Okay, a plan for trade management. First thing you must understand, the only thing that you can control are losses. You can't control profits, you can only control losses. Profits come as and how the market deliver it. Losses is what you make decisions about. Therefore, you have to make decisions about your risk capital. You have to make decisions about your risk percent per trade. That's a trade risk unit. You have to decide what your trade risk unit amount is, and you have to decide which asset to trade. You have to decide about spread sizes and liquidity. Are they in your favor? You have to consider the trade costs, and you have to consider gap risk. Now, when you're making a trade, you have to be clear about what your entry price is, what your stop price is, what your targets might be, what your average true range is, which will inform you of things like targets and stops, room for the trade, and you must therefore make sure you understand all there is to know about trading, candles, candlesticks, how to understand candlesticks, support and resistance, trend lines, trends, and so on. But essentially you must make sure you know about this stuff. And then you've got to think about allocating your capital into trade risk units and allocation of trade risk units into tranches, and then you have to have a trading plan for the tranches. The other thing you've got to take into account is how you're going to execute the trade. Is it going to be a market trade, a stop order, a limit order, and so on? And what kind of trade management you're going to do, when to move your stops, whether stops are more viable for you than alerts or the other way around, when to scale out, if you're going to scale out, and about scaling in if you're going to scale in. You have to be able to identify weakness in the move, and therefore when you're going to take the profit, and whether the trend lines, divergence, and other indicators might give you indication of that. The Cato indicators actually do give you indication of early weakness and allow you to manage your trade very well. There's real-time trading apps that I provide, the M Trader, the Strength Trader, otherwise known as the S Trader. The M Trader is like the Mega Trader. It's a mega trading tool. The S Trader is like gets you in early. It's like a starting trade. It gets you in at the gate early. And then the litmus test is something which guarantees that you should not trade against litmus test. Litmus test is genuinely a litmus test, and when it's against you, do not trade against it. There's the cash to order system and the cash to order BBB indicators. Now, cash to order is an intention, not a promise. I want to make that absolutely clear. It's called cash to order because my name's Cato, which is C-A-T-O, cash to order. And a friend of mine said that it's a cash to order system. Well, as I repeat, it's an intention, not a promise. But as an intention, it's a mighty intention, and it helps me do the best I can for you and for me in my trading as well. So I use this system all the time. Now, the Cato BBB trade alerts is based on 42 different strategies, all wrapped up in one, hidden in an algorithm that trades live, real time, to help you trade. And if you want to find out more about that, you can register and go to 30minutetrading.com and register for the software. So thank you very much for that. Now let's get on with the introduction to the risk management trade calculator. The first thing to say about it is there's 4 different sheets, and I'm going to point down at the bottom. At the bottom here we've got consecutive losses, market overview, trade and risk management, which is a ready reckoner calculator, and the trade calculator template, which is where you store complete trade results. So now let's look at consecutive losses. First thing to talk about is the effect of probable consecutive losses on your account. You have to decide what size of pot you're going to trade and what risk you're going to accept. First thing to talk about is your pot size. You must have an appropriate pot size to allow you to make the trades. Next thing to talk about is a win percent. How many trades do you expect to win? Now let's just hypothesize that it's 50-50. If it was 50-50, then that would be almost like random. You're aiming to get a better win rate than that, but at the moment you might as well just put in, let's suppose it was 50-50. Then we've got the risk that you're willing to take on any given trade. Now if you've listened to some of the, if you've been on any trading courses or whatever, they will often tell you that something like 3% is a reasonable amount to risk. And if you risked 3%, you can see here what would happen to your pot. Now let's go through it step by step. Mathematically speaking, the probability that after 10 trades you have made 3.3 consecutive losses. That's a mathematical probability. So given that that is a mathematical probability on the basis of your trade percentage, your win percentage, then it's also a mathematical probability that within 10 trades you would draw down your account to the tune of 12.96%, or to put it more accurately, to the tune of which you require 12.96% to get back to break even. Break even being your original start units, 10,000. So now if you're willing to mathematically probably within 10 trades lose 12.96% of your account, then you can risk 3% of your account on any given trade. Now clearly my personal view is that that isn't a prudent approach. You need to be working with smaller amounts of risk capital than that. I do know that there are various people out there that will trade with 5% risk capital, and you can see that it's mathematically probable that you will get 3.3 trades wrong in a row, which is mathematically probable you will draw down anything up to 22% of your account within 10 trades. That is clearly not a wise approach to take unless you've got to a point where you're very, very certain about your trading skills. So let's look at what values you could choose. Let's try 2% and see how we do. 2% means that 10 trades you'll probably just about get away with it. I think that, again, mathematically speaking, if you aim to never draw down more than 10% of your capital within a reasonable period of time, then 10% is potentially manageable to make back. But more than 10% is quite a challenge. More than 20% down here is definitely even more of a challenge. Okay. So 2% risk capital is still quite steep. In 10 trades you're likely to get 3.3 wrong, so you're going to draw down like that. In any given 100 trades you're likely to get 6.6 wrong in a row. That means you've got a 15% drawdown in 100 trades. Now if you're a trader, you are going to make 100 trades. So this is going to happen to you, and you are going to lose 15% if you trade at 2% risk every time. So let's look at a better figure. We want to make sure that certainly within 100 trades we're not going to hit a 10% drawdown. So let's try with 1.5 and see where we get to. That's getting better. As you can see, we've got that drawdown at 11% after that amount of trade. So we want to get a bit better than that. So 1.25 perhaps. So 1.25 just does it. Just gets us into that realm. But it means that we will, after 1,000 trades, at some point experience a drawdown of 13.4%. So we might want to be even more prudent than the 1.25%, and we might want to go for, say, 1%, which makes it a much more manageable account. Now you may decide that actually you want to trade with less than that, like for a hypothetical case, 0.5% risk to start with. And if you do that while you're exploring new strategies, then you're protecting yourself while you're experimenting with the strategy. So you're doing the strategy live, you're experiencing live trading, but you're limiting your downside risk hugely if you trade at 0.5% risk. So I hope that makes sense. I hope you understand that's why you want to do it. And after you've got your strategy under your belt, you might then go to 1%. But looking at this, I would say that any more than 1% is high risk. So now let's suppose you've got your strategy worked out and it's working for you and it's in your favor. Let's hypothesize then it goes up to 60% win rate. And if we do that, you can see that after 10 trades, we're likely to get 2.5 wrong in a row. So that's better than we had before. Do you remember we had 3 point something or other? Let's make that down to 50%. You can see how that changes. It was 3.3, right? But if you can move it up to 60%, you can improve the odds in your favor. And this now means that in 1,000 trades, you're likely to get 7.5 wrong, which is still well within the bounds of your tolerance. So this is how you'd work it out. And I suggest in the first instance you never trade more than 1%, and potentially you trade 0.5% risk. So what does that mean? Well, that means that you have to make sure you have an account that you can trade the assets you want to trade that will allow you to do it within this risk size. Let's move on and look at what this really means, okay? So in terms of trade risk management, if we've got 10,000, 1,000, and we've got a trade of a currency, let's say the euro dollar, which is currently trading at 13761. So if I put my entry price as 13761 and my stop price, let's say 20 pips below that, 13741. If you have 10,000 units in your pot, you can trade 5 units for every pip, or 5 mini lots. Now let's just look and see what that means. Does that mean you can trade it on this account? You can. If you had 2,000 on there and you're running a 1% risk per trade, you can go no higher than 1 unit per pip. In the UK, £1 a point, in America $1 a point, in Eurozone €1 a point. It's equivalent to 1 mini lot. So essentially for trading Forex, in the main, if you have less than 2,000 units of capital, whether it's pounds, dollars, euros, whatever account you're trading, it would be unwise to even start to trade if you're going to trade minis. You'd need to be able to trade micros, and that means in units of 0.1 and variations on 0.1. If I bring this capital down to 1,000, for example, you can see you can only trade 0.5 pounds a point, dollars a point, euros a point, or 5 micros. And therefore you need an account that would permit you to do that. Otherwise you're going to be out of the game quicker than you can blink. So just be mindful of that. Make sure your account size is the right size to be able to trade, and make sure the amount you risk per pip is exactly the right size. Then you'll be able to trade for a longer period of time and get the experience under your belt. So yes, that's that. Now this particular trade management tool here is one where you can quickly get an idea about how much you can trade. And then the trade calculator allows you to put into here in more detail what you can trade. And let's go through this one by one. You can put in the capital in here, so let's say it's 10,000. Your risk per trade, so let's say it's 1%. You're trading euro dollar, so that's fine. The trade entry price you enter down in this column here, so that's down through these columns here. And if you have purchased the Cato 30-minute trading system and indicators, you will also be getting the bull bear butterfly values, indicator values for the trade. Now what this means is that if it rates green on the weekly, daily, 4-hour, 1-hour and 30-minute chart, it is strongly bull across the board. This gives you a clear idea about the safety to trade. In here you put the spread, and that spread is then used in conjunction with the weekly average true range, daily average true range, 4-hour average true range, hourly average true range, and 30-minute average true range. Now these average true ranges are indications of how far the price action might move in any given period of time. For example, 4 hours 24, 1 hour 12.9, 30 minute 9.6. And the calculator calculates here the risk reward ratios, and if these are all green as well as these being all green, you've now got a clear indication that this particular currency, this particular asset is tradable. First off, you've got everything in a consistent trend, because the bull bear butterfly indicator is telling you that, and it gets rid of the first doubt that many traders have in their minds about which way to trade, is it safe to trade now or not, and so on. If all of that is green, it's safe to trade long. It's not safe to trade short. If all of these are green, the risk reward ratios are powerfully in your favor, and that means not only is it good stock to trade, good asset to trade, not only is it a good currency to trade, it's good from the point of view of its trend, it's good from the point of view of its risk. So now we have a viable, valid trade. We've got 10,000 units to trade with, we've got a 1% risk, we've got our entry price and our stop price and the current price and our technical target number 1, technical target number 2, and you got the margin here. So you put in all of those values and it tells you you can trade on this particular trade with everything as you specified it, 7 units, a maximum of 7 units. Now you may take a view that this is a highly probable trade, in which case you may trade all 7 units. This part of the spreadsheet gives you an idea of what you can do. The ATR, the average true range, on a 30-minute, let's say we're trading a 30-minute candle, is 9.6, so we put in there 10. And this part of the column here tells you the details if it was all worked out for you. All right. And this works out what it'd be worth if you traded certain values. So let's say you decided to control only 3,000 units of the currency, then you put in 3,000 units in there. If you want to trade, say, 20,000 worth of currency, then you put that number in here, the 20,000, and it will tell you how much you can trade per unit. So that works out you've got 1 mini lot or 1.45 mini lots, or 1 mini in 4 micros. Okay, does that make sense? I hope it does. So now let's look at what would actually happen. Suppose you place the trade, and you put the trade entry details in here, and you put the trade actual amount that you placed in there. So let's say you traded 6 units. or 6 minis, then that's what you put in there, 6 minis, okay? And now it will give you all the details you need to know. It gives you the risk amount, the risk value amount, the risk percent on your capital, tells you how much margin you require to trade that. So you need 4,000 margin if you've got a 5% margin requirement. And if the margin requirement was 1%, you can see that then the margin required is 825 units, right? And it tells you that the position controlled by trading with 6 units or 6 minis is 82,000 units of Forex, of euro dollar. It now tells you down here again that your risk pips is 14, your risk value is 84, your reward pips at target 1 is 10, 20 for target 2, the reward value for the first target is 60, reward value for the second target is 120. And if you wanted to, you can put in your own personal probability figure in here. So say that you think it's going to be a 65% probable trade, then it works out in there whether the risk reward is in your favor or not. And you can see it's about 1 to 1, which is not highly strong for this particular trade, but it gives you an indication. So here we have the trade that we can actually make. This area here makes an estimate of how much you can trade based on the price and the amount. So that's the price of the currency and the amount of capital you have, with the risk that you're willing to take and the risk amount you're willing to take. So here it's saying that if you're trading on the 4-hour chart, the stop pips it estimates on the basis of ATR is 24 stop pips. That means that you can afford to trade 4 units, £4 a point, 4 units a point per trade. And you can trade on a 30-minute 10 units a point. Here, because this is in the UK I'm talking from, it's £1 a point. But if it was in America, it'd be $1 a point, and in Europe, it'd be €1 a point. And that would trade 0.42 lots or 1.04 lots. So that's 4 minis or 1 standard. And it would control about 143,000 of currency, and that controls 57,000 of currency. So there you have it. That's how you use this part of the calculator and spreadsheet. If you're going short, you put the same set of values in here. So you enter the entry price, your stop price, your technical stop price, the current price, which at the moment is calculated as being the same as that, and your target 1, target 2, your ATR, and the amount of value that you wish to control. And it gives you all the final results, like how much can you actually trade per point. So this would be minis per point, 4.76. If you're basing it on the ATR, it's 4.17 minis per point. If you're basing it on value, it'd be 2.2 minis per point. And then this again gives you your risk pips, your risk value, your reward pips for target 2, your reward values, and your risk reward ratios, and you can see that that is above 1, so that's good. And it gives you a reward percent of 1.86%. So if you hit target 2, you'd increase your capital by 1.86% on that one trade. Now, the other thing that you can do if you want to be very careful about managing your trades is to actually record what you're doing. So let's come down here a bit, and you can see that you'd enter your results afterwards, the trade, into here. You put the close price in there, and when you put the close price in there, let's suppose that we've gone long. In this case here we've gone long, and we put in the close price. So let's suppose we hit our second target, 13775. Maybe we even got beyond that. Let's say a bit more, 13778. It will tell you here what your reward pips are, what your reward value is. A reward percent here is 1.38, your reward risk is 1.64. So that's a good return. And then what you can do is paste in down here a copy of the chart, the trade chart. And in this case the trade chart has the chart here, which is the candle chart, and I've got the Cato trade indicators, which you can get from me if you're interested. Now these ones are actually, this is the S trader, and every time the S trader pokes up it says there's a potential long trade. Looking at this chart, actually I did take this euro dollar trade off this potential long trade here. We've got the S trader poking up, we've got the M trader poking up above 0, we've got the litmus test come to 0, and even though this is, the bull bear indicator is bear, we can see we're in a sideways channel, so we're looking for trading the channel, and this allows us to trade the channel by watching these indicators. The average true range is down here, and you can see this area here. So I traded a trade on the basis of this, going long if it broke out above this level here, on the basis of this S trader kicking up, M trader kicking up, litmus being neutral, and we're trading the channel. That's the plan. I put a target of 1 ATR, so I was targeting just one move, and I traded the trade from this level here to this level here at 137.665, making 10 pips and putting away, I think it was about $50 worth of cash as a result of the trade. Traded it quite light, traded it with 5 minis, so there you are. So that was it. Put away $50, and that was the trade. It was all done in about half an hour. And this is the chart for the trade record, complete with all of the indicators telling you when to go. And you can see quite clearly here how it works. You can see that every time that these indicators trigger up, S trade has gone up, M trade has gone up, litmus test is neutral, you can see that it indicates that move. Now without the indicators you'd think you're in a bear move, and so you wouldn't be interested in taking it, but with the indicators you can see that off this candle here we got a potential for the move. M trader confirms it at this level here. If you got in at that level, your stop is very tight, your risk is very small for the potential reward of the channel trade to the upside, and you take that trade based on the ATR, which is here. ATR tells you how far you might expect to go. You're looking to trade 2 ATRs for a good trade, 1 ATR for an average trade. And if you're trading just one tranche, then you just trade it with 1 ATR, and that's basically how you do it. You can see that it happens very, very often that the trade will work in your favor. And when you see a chart like this, you're looking to channel trade rather than trend trade. You can see that this indicator here, the Cato bull bear butterfly indicator, it essentially is over this period here, which is moving around on the 30-minute candle. You can see that it moves up and down and up and down. We're going sideways essentially. So you're definitely looking to trade the trades as you make the reversal. We've got a very noisy period in here, which is hard to trade, but then it starts forming a serious move to the upside. Here S trader is just kicking into a trade long, so you can take that, and then this one, M trader here, trades you long, so you can take that. Litmus test is long, so they've all stacked up long at this point here. When litmus is against you, you shouldn't trade. You shouldn't trade long when litmus is against you, and you can see here that litmus would keep you out of this mess, even though S trader and M trader are telling you to get into it. The only time that litmus test gives you a potential long is here, which is saying trade long if it breaks above that level, and clearly it didn't, so you didn't get the trade. Whereas the next time you get an opportunity for a trade is around here, where that kicks long, that kicks long, and that kicks long, so that's long at that level there, and you get the trade to the upside. Anyway, that's how you use the Cato bull bear butterfly indicators, and whether or not you're using them, you should record down here the chart So you've got a full record of the trade you've made. And that's how to use these indicators. Now, there is one more thing to all of this, and that is the market overview. The market overview allows you to make a detailed overview of all of the different currencies or assets that you're trading. So this would be all the Forex currencies. Then you can put in other assets down here, whether it's indices or whatever it is that you want. Up here you can see that various other indices and commodities like gold, crude, silver, the Australian index, the UK index, the DAX, the French CAC, the Hang Seng, the Japanese index, the RUS, the Dow Jones, the Aussie yen, the Aussie dollar, chief yen, and so on. And all of these are recorded in here. And along here you can see the weekly bull bear butterfly figure, the daily, the 4 hour, the hour, and the 30-minute. And when this data was compiled, you can see that gold was bear on the weekly, bear on the daily, bear on the 4, bear on the hour, bear on the 30-minute. You would not be interested in trading that long, you'd only be interested in trading that short. Here are the ATRs on it, and over here you can see that the weekly figure for reward to risk ratio is 102, green, daily 36, green, 4 hour 13, green, hourly 4, green. So essentially you're looking to trade gold short, and probably on the basis of the hourly chart or the 4 hour chart. You could go for a daily chart too, but it's amber, it's not quite so strong. It is a good risk reward, but it does indicate that potentially what you should be looking at is a 4 hourly chart trade of gold short, where you're looking to get a reward to risk ratio of 13:1. And that's how you'd use this. You can see other areas of this where you've got conflict. Okay, so here for example the Aussie yen, we're green weekly, that's bull on the daily, that's bull on the 4 hour, but here we're bear on the hour and we're bear on the 30-minute. So we have a conflict between the 4 hour and these, and we're long on the rest of the time. So really we're looking for an Aussie yen long, but it's telling us that actually we're short. So you would not want to take that trade. Let's have a look and see if there's any other information we can get. You can see that the reward to risk ratios are not green. So in that case, having entered this data here, you'd go, okay, this is not viable as a sensible trade at this stage. However, the Aussie dollar is bear, 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 bear. And the reward ratios are green, 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 green. So we're looking to trade Aussie dollar short with good risk reward ratios. So okay, note that actually that means that the Aussie dollar is a sensible currency pair for us to look into trading short. And we can then follow across and find out what we should be trading it. So you can see here that with this particular asset here on the 4 hour, we're looking to trade 2 to 3 units per point short, and that's 0.27 minis, right? It's 2.7 standards, which is 2.7 mini lots. And our stop pips are going to be about 33 based on the ATR of 1 ATR. And that's how you would use this part of the calculator and spreadsheet. All you have to do is take the figures off the bull bear butterfly indicator and the indicators that I provide you with, put in the values in here, put in the values in there, and it tells you everything else you need to know about whether this is a good trade to even investigate. I hope you found that really useful. I hope you found it good for you to learn how to do that. Do pay attention when you're trading to all of these fine details, because it will keep you in the business much longer. And if you have any further questions at all from me, please do just contact me. I'm john@30minutetrading.com. Email me anytime you like, or support@30minutetrading.com, and you can get a hold of me or somebody on the support team who will get back to you and answer any questions you've got. I hope you found that really useful. This is John Cato at 30minutetrading.com, wishing you well and happy trading.